Hello and welcome to the UK Mortgage Market Insights for the weekend in the 17th of April 2026. I'm Craig. This week we've actually got some cautiously positive news on the rate front, but as ever, context is everything. So before we get into that, if you're new here, please do hit subscribe because there are new videos every week keeping you up to speed on everything mortgage and property related. Right, let's start with the rates because there has been some movement and for once it's in the right direction. This week we've seen reductions from some of the biggest names on the high street: HSBC, Santander, Halifax, Coventry, Leeds, TSB, and a handful of smaller lenders have all trimmed their rates. The maximum reduction we're seeing is around 0.4%, so not enormous, but it's a step in the right direction. Now, I want to be really clear about this. Don't get overexcited, because here's the context that matters. Since the start of the conflict in the Middle East, mortgage rates have increased by over 1%. So these reductions, while welcome, they are not reversing it. We're not back to where we were, not even close. And the reason rates moved in the first place hasn't gone away. The ceasefire is fragile. We're hearing increasingly threatening language from the US directed at Iran, and if that ceasefire breaks down, swap rates, which I'll come to in a moment, could escalate very quickly. And when swaps move, lenders follow fast. So, welcome the reductions, but keep one eye on the news. Now, let's talk about why lenders have been able to cut, because it all comes back to swap rates, as it so often does. The 2-year swap rate was sitting at 3.988 last night. Last week it was 4.2%. That's a meaningful drop in 7 days, and that's directly why lenders have had headroom to reprice. The 5-year swap was at 4.013, down from 4.15 last week. But here's the wider picture. A year ago, the 2-year swap was 3.919, so we're actually slightly above where we were 12 months ago. The 5-year was 3.75, and we're still over 0.25% above that. So these are improvements, but we haven't recovered the ground lost since the conflict began. And as I mentioned earlier, one flare-up in the Middle East and those numbers can move sharply in the wrong direction. These two stories are completely connected. Right, let's talk about the broader economy, because this week we've had some genuinely interesting data that tells two very different stories dependent upon which direction you're looking. First, we've got GDP. The ONS this week released figures showing that in the 3 months to February 2026, the UK economy grew by 0.5%. That follows 0.3% growth in the 3 months to January and no growth at all in the 3 months to December. So, the trajectory is improving. Monthly GDP in February came in at 0.5%, up from 0.1% in both January and December. Services grew and production grew. And when you look at that trend, no growth at 0.1, 0.3 and 0.5, what you're actually seeing is a market that is finding its feet. Momentum was quietly building. An improving picture was genuinely emerging. These figures, in another world, would have been the start of a really positive story. But that's almost what makes them harder to look at, because these numbers are as much about what should have been as what is. The conflict changed the trajectory. The energy cost shock, the swap rate spike, the uncertainty, all of it arrived just as the economy was starting to move in the right direction. So while the data is encouraging on the surface, it carries a real sense of missed opportunity. Construction output is the other note of caution, falling 2% on the rolling 3-month measure, the third consecutive quarter of decline. For anyone watching the housing market, that matters. Supply isn't keeping up, and that has consequences for buyers further down the line. Now, here's where the two stories diverge, because while the short-term ONS numbers look encouraging, the IMF this week downgraded the UK's growth forecast for 2026 from 1.3% down to 0.8%. That is the largest downgrade of any G7 country. Let that land just for a second. Now, the reasons behind it are the conflict, fewer rate cuts than previously expected, and the expectation that higher energy costs will linger well into next year. And here's what really struck me. The IMF has urged central banks to be cautious about raising interest rates to counter higher inflation. And that's something that I've been saying for quite some time. Rate hikes in this environment, with weak construction, with consumers already squeezed, with GDP only just finding its feet, would be the wrong medicine. And the IMF appears to agree. When you put the GDP data alongside the IMF downgrade, it paints a picture of what this market could have been. The green shoots were there, the momentum was building, and then the conflict changed everything. It is genuinely a shame, because without that backdrop, we would be in a very different place right now. So what does this mean for you? Well, let's bring it all together because I want to make sure that when you leave this video, you leave with something practical. If you're looking to buy, this is still a buyer's market. I'm seeing it on the ground every single week. Negotiations on purchase prices are real and they are happening. Sellers know the market is quieter and buyers have the leverage right now that they simply won't have when rates start to fall. And here's the thing. Be careful what you wish for when it comes to rate cuts, because the moment rates drop meaningfully, pent-up demand returns, and there is a lot of it. It floods back, and when that happens, it becomes a seller's market almost overnight. The negotiating power that you have today disappears. So slightly higher rates, frustrating as they are actually working in the favour of buyers right now. So use that window wisely. If you're remortgaging, I want to be honest with you, because the picture is less positive. The rate reductions that we're seeing from lenders this week are largely aimed at purchase products. They're not really filtering through to remortgage pricing in any meaningful way. And that's a real shame because this year, 2026, approximately 1.8 million borrowers are coming off fixed rates taken out before the Liz Truss mini budget. Rates as low as 1%, some even lower than that. The jump they are facing is significant. The market right now is focused on attracting buyers, and those coming off ultra-low fixes are largely being left to absorb the pain. So what's my view on all of this? Well, look, rates are moving in the right direction because swap rates are easing, and therefore lenders are responding. But this is not over. The geopolitical situation remains fragile. The IMF is flagging real headwinds ahead, and the construction data tells us that the supply isn't going to save us anytime soon. Take the positive signals for what they are, early signs of improvement, but make decisions with your eyes wide open. If you're not sure what the right move is for your situation right now, speak to a broker, a whole of market one that offers independent advice. That's what we're here for. Well, that's everything from me this week. Thank you so much for watching. If you found this useful, please do hit the like button, share it with anyone who's buying or remortgaging this year, and subscribe if you haven't already. I'll see you next week, so take care.